Welcome everyone to Chartered Accountants Worldwide Network USA webinar, What's Happening with IFRS. I'm Jeff Aldridge. I am the president of the Chicago chapter of Chartered Accountants Network USA and also a tax principal at BDO. Before we start, I'm going to run through some housekeeping for today's webinar. First up, there is a handout available and you can download this from the control panel for this event. Also, this webinar is CPE eligible if you have requested it. In order to qualify, you will need to answer the polling questions we will be asking during the webinar. There are 5 polls during the webinar and a survey when you exit. You need to answer at least 3 of the polls to qualify and attend for at least 50 minutes. The format of this webinar is an hour-long presentation, including this introduction. If you have any questions while we are presenting, please note them in the Q&A on your control panel, and we'll try to get to them during the webinar, but if we don't, we'll follow up thereafter. We will be recording the presentation and we'll make it available on our website, and that's the Chartered Accountants Worldwide Network USA website, after today's presentation. At the end of the webinar, when you exit and take our short survey, please do let us know what you think. Also let us know if you want to connect with any of the presenters. So for CPE purposes, I have to let you know what our learning objectives for today are, and they are that after the presentation, you should be able to describe timely IFRS accounting standards guidance, hot topics and resources and their general impact on global accounting and financial reporting. You should also be able to describe updates to IFRS accounting standards that have occurred over the last 6 months and how they compare with the guidance included in US GAAP. And finally, you should be able to describe anticipated upcoming changes to IFRS. This presentation will be followed up by a wrap-up session and, as I said, audience Q&A if we have time. With that, I'm going to hand over to Andy to run the first poll. And while you are responding, I'm going to introduce our team as well. Okay, so as I said, my name's Jeff Aldridge. I'm a tax principal at BDO. I'm also joined by 4 of my IFRS advisory colleagues at BDO. So joining me, I have Andrew Moore. He's a director in our professional practice team. Oscar Ayala Murillo, he's also a director in our professional practice team. Shane Klassen, who's a senior manager in the same team. And that is the group of presenters for today. And I will ask if everyone has had time to complete it. I guess Andy to close the poll and share the results. And while he's doing that, I will also hand over to Andy to begin the training.
All right. Thanks, Jeff. So let me share the results of the poll. Seems like we got about 70% of the group that does use IFRS as part of their day-to-day work. Okay, so let's just jump back and run through our agenda real quick. So we're going to run the gambit of a few different topics today. First of all, we'll talk about cash flow statements and some key reminders, especially as we're coming into the season where you're probably preparing the December year-end financial statements. We're going to run through some regulatory enforcement priorities, which is really just kind of highlighting some hot topics and interesting areas and good reminders. Again, we're preparing financial statements. And then Shane's going to take us through the amendments to IS1 and those updates to the classification of loans as current or non-current. And then we'll run through quickly the changes that the ISB and the IFRIC are currently proposing at their latest meetings in January, February and March. And then we'll talk through some of our resources, and then any questions that have accumulated, we'll we'll run through those at the end if we've got time. Okay, so with that, I will hand over to Oscar.
Well, Andy, thank you so much for the introduction. And let's jump right into cash flows. So welcome everyone. And as Andy mentioned, these are a few key reminders that are related to the cash flow statement, as it sort of remains a critical focus, not only for regulators, but also the sort of emphasizing the importance that the cash flow is to the financial statement as a whole, and accurately reflecting those cash movements. And it's also an area where the misstatements and errors frequently occur, and not only within the financial statements itself, but also within the footnotes. And as you know, these errors could have a significant implication for the financial reporting and compliance. So today we'll be highlighting a few common pitfalls, the errors that we usually identify during our review of the financial statements, and some regulatory expectations and best practices that ensure the cash flows itself, the financial statements and disclosures meet the required standards as you prepare those or are reviewing those financial statements. Next slide, Andy. So let's start with a quick overview of the cash flow statement. And the cash flow statements report changes in cash flow that are, or cash equivalents, classifying those that are operating, investing, or financing. And IAS 7 defines operating activities as sort of the principal revenue producing activities of the entity other that are not investing or financing. So generally, cash flows from operating will sort of present movements in cash and cash equivalents that are sort of resulting from the operation of the company in the statement of comprehensive income and arriving at the profit or loss. The operating cash flows could be sort of reported using the direct method or the indirect method. Most of you are sort of probably more familiar with the indirect method. However, the direct method is where all major classes of gross, cash receipts, and cash payments are disclosed. And on the other hand, the indirect method are where the profit and loss gets adjusted for those effects of sort of non-cash nature or deferral of accruals or past or future operating cash receipts or payments that are sort of associated with investing or financing cash flows. Now, if you were to look at the standard, it does encourages, but it doesn't require the reporting entities to use the direct method. However, if you were to use that direct method, keep in mind that a reconciliation of net income to the net cash flows from operating activities need to be provided in a separate schedule or within the footnotes. Now, also a few key reminders related to those operating activities is that the usual question that comes up is that what should be the starting point of using the indirect method? And under IFRS, basically is widely accepted to start or begin that operating cash flow from either operating after taxation or profit before taxation. Now, the most important point here is that the starting point should not be misleading, and the outcome should sort of be or reflect the cash flows from the operating activities. Now, from a regulator's point of view, in some jurisdictions, they sort of apply a narrower interpretation of that and only consider it acceptable to start that reconciliation from profit after taxation, before taxation, or only in terms of continuing operations. In terms of the investing activities, and these are basically activities that relate to the acquisition or disposal of long-term assets and other investments that are not included within cash equivalents. And a key aspect of investment activities is that only relate to expenditures that result in a recognized asset in the statement of financial position or balance sheet that are eligible for classification as cash flow for investing activities. Now, in terms of financing activities, and these are activities that cause changes to the equity and borrowings of an entity. So those are sort of cash flows from financing activities that comprise receipts or payments in relation to obtaining, servicing, and repayment or redemption of debt, an equity source of financing. Next slide. Oh, that right there, cash equivalents. So what gets included in cash and cash equivalents? And sometimes could be a very straightforward process, sort of in terms of understanding the maturity period of 3 months from the date of initial investment. And that sort of comes into the definition, right? That they're ready, convertible, and subject to significant risk and changes in value. So that could be a very straightforward process. So, however, there is a few instances that we've seen that where there is a sort of a need to stop and reflect and identify circumstances in which it could be a little bit more challenging. And a clear example of that, and we see that often, is in relation to market funds, which that may meet the definition of a cash equivalent, but that's not always the case. So, or investments in which a IAS 7 does not provide really a definition of the context of cash equivalents. A few observations have sort of been raised related to the disclosure and a presentation of bank overdrafts, and that is sort of a big difference in terms of IFRS and US GAAP, where the disclosure and presentation of bank overdrafts that are repayable on demand, and that overdraft is also integral to the company's cash management. So should that be classified, now we're talking about IFRS, should be that classified as cash and cash equivalents. So the fact that the bank overdraft is classified as a cash and cash equivalent only for the purpose of the cash flow doesn't mean that it meets that definition and should be removed from the liability side of the statement of financial position. So it will show as a liability. However, it is classified as a cash equivalent as only for the cash flow statement. Now, the point I was sort of trying to make here is that for companies, it is very important to have a very clear accounting policy and describing exactly what is included in cash and cash equivalents, and sort of avoid that boilerplate disclosures on the financials, and for also, if you're an auditor, to understand and challenge those assumptions that the company is making in terms of including certain items as cash equivalents. The next slide, Andy, please. All right, so let's go through our first case study, and the facts are as follows. Spurs LLC, construction company, main business is building condominiums in downtown Chicago. They do receive special escrow accounts that are used as a method of financial support. And these payments are from the customers who will be purchasing those condominiums. The lending bank provides the credit for the project through the special escrow accounts. And these accounts are released to the developer by the bank only after the completion of a substantial part of the project in accordance with conditions. An important point to that is that the escrow also is fully pledged in favor of the lending bank, and the lending bank has a contractual right to delay that withdrawal of funds from the escrows. So the question here, our first for the case study, is first controller, Mr. Sun, is suggesting that the company should classify the special escrow accounts as cash, or at least as cash equivalents in the financial statements. So is that statement correct? And we go to the next slide. All right, so Mr. Sun, unfortunately, is not correct because the escrow accounts cannot be classified under cash and cash equivalents on the IAS 7. As we sort of point out, sort of like the last point, and within the facts, is that the withdrawing of the funds from the escrow accounts is subject to the approval of the lending bank where the funds are deposited, but the bank has the right to delay that withdrawal of the funds. Therefore, this cannot be considered as demand deposits. So this sort of case, and we want to bring this to sort of point out the difference between that specific case study to the situation that was discussed in the IFRS decision, which dealt with demand deposits. And if you sort of read that, and we encourage you to read that, is that they concluded that the restrictions of the use of a demand deposits arising from a contract with a third party do not usually result in the deposit not longer being cash, unless those restrictions sort of change that nature of the definition of cash under IAS 7. So we included a link here on the slide on the handout on the presentation, and it does provide the guidance or how to present and disclose such deposits. Next slide, Andy. So now let's have a look at other considerations that are usually sort of findings by the regulators, as well as usually that we sort of see when reviewing cash flows. And the first one is gross versus net presentation. And sort of the principle in IAS 7 is that pretty much all cash flows should be presented gross, and netting is permitted only in very limited circumstances. So, for example, an entity might acquire an asset on their operating asset or lease, or we might acquire a business through issuing shares. That is also a point where we just want to make sure that those non-cash items should be also presented separately. And we'll go through a few examples later on. Now, there's only two instances where cash flow can be shown net on the cash flow statement. And the first one is where cash receipts and payments are on behalf of customers and reflect that customer's activities. So for example, when a company is acting as an agent. And the second category where you can present as net are for items where the turnover is so quick and the amounts are large and the maturities are very short, which in practice is considered basically 90 days. Now, a second point of the things that we sort of find and when reviewing cash flows is the classification that is outside of the operating cash flow. So a lot of companies sort of like operating cash flow is the default category. So anything that doesn't meet the definition of an investing or financing cash flow gets reported as an operating cash flow. Now, one of the key also areas as well relate to the inconsistencies between the information that is presented on the statement of the cash flow compared to the notes of the financial statements. So for example, certain balance sheet movements of transactions that are described in the financials are not properly reflected or have a corresponding cash flow, or a sort of proper reconciliation of additions in the PP&E. I mean, something sort of very obvious from the financial statements, but is that reconciliation of PP&E to the cash outflow of the acquisition of the assets. And also is an error that we usually find is the movement in the working capital on the cash flow statements that goes under the operating activities, right? That doesn't appear to be reflected on the balance sheet, or the working capital amount reflected on the cash flow doesn't reconcile to the movement year over year from the balance sheet. Let's move to the next slide, Andy. So let's bring some of these considerations that we just talked about this case study. And the fact of the first example are as follows. Madison Manufacturing in June 2022 entered into a $5 million line of credit balance, and in 2023 and 2024, the company increased the credit line capacity to $3 million and $5 million respectively, and extended that maturity to the June 2026. Now, as of December 31st, 2024 and 23, the outstanding balance was $2.4 million and 1.5 million. On December 31st, 2024, James, the CFO, assessed the presentation of the line of credit in the company's consolidated statements of cash flow and sign off on the following presentations. So they had as proceeds from the line of credit, as you can see, by 991,000 on the cash flow for financing activities. So the question here is that a presentation of the change in the line of credit being presented correctly in the consolidated statement of cash flows? So next slide. And again, unfortunately, the CFO was not correct, and the presentation of proceeds was misstated. Now, remember that the company extended the maturity of the line of credit to June 2026. And in accordance with IAS 7, the cash flow that are associated with the proceeds and the payments that are related to specifically to that line of credit did not meet that criteria of net presentation. And the main sort of reason for that is that the line of credit was significantly greater than 90 days. And therefore, the company was required to present those cash flows by presenting the proceeds and the payments or repayments separately, as presented here on the slide. Next slide, Andy. Okay. So now let's have a look at the next example, sort of to explain some of the cash flow considerations also discussed previously. And the facts on this example is in November 2024, White Hart Lane Inc. issued 183,000 shares of Series A of preferred stock and 91,500 warrants to purchase common stock for the total proceeds of 1.8 million, which consisted of 675,000 in cash and 1.5 million in the form of 525 barrels of aged whiskey. So the CFO performed a final review of the company's cash flow statements, and a total of 1.8 million is presented in the proceeds for preferred stock within the financing activities. So again, the question is, has the company properly presented this transaction in the statement of cash flows? And let's go to the next. There we go. Thank you, Andy. And again, the company was not correct and had to restate the cash flows. And in the initial filing, as you can see, the company presented the total proceeds of 1 million as just a cash outflow on the financing activities. So, however, the total proceeds also included barrels of whiskey. So they had to restate the cash flow to reflect the impact on the operating activities that are related to the inventory, right? Barrels and the whiskey that were used as proceeds for 675,000 cash and the portion of the proceeds. And they also had to add an additional disclosure of non-cash payments or non-cash items, related to the investing and financing activities, which sometimes companies missed as a required disclosure. And I think with that, we move to Andy, right?
Yep, we've got a quick polling question, which I'll run through now.
All right.
Thanks, Oscar.
Oh, thank you. Appreciate it.
All right, so the quick polling question is just on, should non-cash investing and financing activities be disclosed separately? If you put your thoughts here, yes or no. All right, great. Okay, so then let's move on to the next slide. The answer to that one was yes, which 97% of people got right. Okay, so this section, we're going to talk about regulatory enforcement priorities. And so this is really, we're aware that a lot of the audience probably don't have these regulatory requirements, but I think it's a good data point of hot topics and things that are interesting and that we should be getting right in our financial statements. So we're just going to spend a little bit of time going through that. So we're going to talk about ESMA, which is a European Securities and Markets Authority. They published 2 reports recently that we're going to look at. The first is an annual publication on ESMA enforcement priorities for the upcoming reporting season. And the second is a new publication from ESMA on carbon allowance accounting in financial statements. So we won't spend much time on the carbon accounting one since it's pretty niche, but we have included a link in the slides here if anybody would like to go into that section in more detail. Okay, so next we'll discuss the ESMA's European Commission Common Enforcement Priorities. The European Commission Enforcement Priorities has three parts. So firstly, the traditional financial reporting in the financial statements, where ESMA draws focus to liquidity considerations and the disclosure of accounting policies, judgments, and significant estimates. So they're the key themes from a financial statement perspective. They also have these two other legs that they're looking at, one of which is around sustainability, which is going to be required in Europe for the largest filers for December 2024 year ends. Interestingly on that, there's been some change in the regulation in Europe that's kind of pushed back the sustainability disclosure requirements for many companies. But for the largest, it is applicable for the 2024 year ends. That change is significant if you do have operations in Europe. I think when we were looking at our client base, it took away a large proportion of our clients that we thought would be in scope and out of scope. That moved accidentally. All right, and then the third point is the European single electronic format reporting. But again, so our focus today is going to be on the financial statements. We just wanted to give you that context. So let's look at some liquidity considerations firstly. So for supplier financing arrangements, amendments to IAS 7 and IFRS 7 became effective on the 1st of January 2024. So whilst this is typically only seen on larger businesses, it is a topic we've seen in practice. So we just wanted to highlight ESMA's thoughts and focus area here. So ESMA highlights the need to disclose key terms and conditions of these arrangements and appropriate reconciliations of balances. Disclosure should also include ranges of payment due dates. And ESMA also highlights that disclosures beyond those specifically listed in the standard may be required in order to meet the overall disclosure objective in IAS 7 44F. And these arrangements should also be considered when you're preparing your disclosures concerning liquidity risk. So ESMA also highlighted the amendments to IAS 1 regarding the classification of loans as current and non-current. I'm not going to spend too much time on this here because I don't want to steal Shane's thunder later on, but certainly there is focus, and I think it's important to note the changes in the disclosure requirements that are upcoming, well, that are applicable now around those loans and with their due dates, and those with covenants too. And then, yeah, I won't steal any more of Shane's thunder there. On the financial statement side of things, on the cash flow statement side of things, ESMA highlighted a number of common errors. But again, I think that goes back to a lot of what Oscar's already said, so I won't dwell on that too much. ESMA also highlighted these topics related to accounting policies, judgments, and significant estimates. So speaking generally, ESMA continues to emphasize the need for entities to make disclosures that are entity specific and not boilerplate. This has been a topic for a while. They also emphasize the need for there to be consistency in these disclosures with other information within the financial statements. So for example, issuers should consider including sensitivity analysis when there's a risk that small changes in the assumptions or estimates lead to a material adjustment to the carrying amounts. So ESMA emphasizes that issuers should focus on judgments and options that have been made in reaching accounting policies and to avoid accounting lessons. So for example, a tax footnote that basically just regurgitates what's in IAS 12, IFRS 23. So ESMA also made specific comments about the disclosure of judgments and estimates that relate to the assessment of control, joint control, and significant influence. So in situations where an entity has made conclusions that are contradictory to its voting rights, then relevant information that has been considered in reaching that conclusion should be disclosed. So just to bring that to life, for example, if you've got an entity that controls, has 51% of the voting power of another entity, but for some reason concluded that the entity did not control it, then the reasons for this should definitely be disclosed. I know we've touched on this in other webinars too, but this is definitely an interesting area and one we see some focus on it. And we see in practice too with associates and significant influence, and where perhaps you reach a conclusion that differs from the kind of they're not red lines, but like the guidelines around like a 20% investment and automatically being an investment in associate. We've seen instances where you've got less than that percentage investment, but you can still conclude that you've got significant influence. So one to be aware of. ESMA also made specific comments about the disclosures related to revenue from contracts with customers, so IFRS 15, and they emphasised the need for clear disclosures, particularly as they relate to long-term contracts. So, for example, judgments that have been made in determining that the definition of a contract continues to be met throughout the life of the contract, and disclosure of judgments and estimates made about the estimates of cost when they are relevant to recognising revenue over time. They also emphasise judgments being made about whether an entity should recognise revenue gross as principal or net as an agent. So again, some of those judgment areas, it's definitely important for the user to be able to understand the decisions that have been made there, or the judgments that have been made there. Finally, ESMA emphasised disclosures about the timing of revenue to be recognised in the future on existing contracts, so where there's a backlog, and also emphasising the importance of reconciliations of opening to closing contract asset and liability balances. Okay, so just a short section there. I'll open up the next poll. Polling question number 3, which asks the question: in general, ESMA continues to emphasise the need for entities to make disclosures that are entity specific and not boilerplate. So as we do that, I think I'm going to get ready to hand over to Shane next, and let him talk about the amendments to IS1. Excellent. All right. So I'll hand over to you, Shane, for the next section.
Thanks, Andy. Thanks for leaving some thunder for me. So good morning, everyone, or good afternoon. My name is Shane Claassen, and today I'll be talking through the amendments to IS1 that deal with the classification of loans as current or non-current. And this is actually a really pertinent topic, given that it's applicable to entities with loans, which is most entities, and so it means it's very widely applicable in practice. And the reason we're talking about this now is because these amendments, which have been quite a long time coming since they were first announced back in 2020, are now finally effective for the first time for December 2024 year ends. So because of this, we thought it'd be valuable to take this time to refresh ourselves on what exactly the amendments are and what they mean for companies. So there are actually 2 sets of amendments to IS1 that are effective for the periods ending on or after Jan 1st, 2024. The first set of amendments, dubbed Classification of Liabilities as Current or Non-Current, was issued back in Jan 2020. Following this, however, stakeholders raised significant concerns on some aspects of the amendments, and because of the furor around it, in response to that, the IASB then further amended IS1 again in October of 2022 by issuing a set of amendments called Non-Current Liabilities with Covenants. And so the 2022 amendments then modified, or in some instances actually reversed, the 2020 amendments, and also introduced some new requirements. So long story short, in this segment, we're going to be covering the combined effect of the 2020 and 22 amendments. In other words, the final requirements of IS1 as they stand now. And our focus will obviously be on the classification of loans as current or non-current, as this is what we expect you to encounter most commonly in practice. So just to note, the amendments also included some clarifications to the term settlement, and we have included slides for these at the end of the segment for completeness sakes. However, we won't be covering these in any detail as we don't think they'll be as widely applicable. Okay, so next slide, Andy, please. So the first thing these amendments did was to amend the wording to IS1 paragraph 69 and insert new paragraphs 72A and B. Paragraph 69 sets out the requirements for the classification of a liability as current, and specifically paragraph 69D was amended to require an entity to have a right at the end of the reporting period to defer settlement for 12 months. To further clarify the principle of a right to defer settlement, the amendments introduced paragraphs 72A and B. So paragraph 72A requires the right to defer settlement to have substance and that it must exist at the end of the reporting period. 72B was introduced to set out the requirements for the classification of loan arrangements that are subject to covenants. Often, loan arrangements require the borrower to meet certain conditions, such as working capital or debt equity ratios, and a failure to meet these conditions, referred to as covenants, result in the lender being able to demand an immediate repayment of the loan. Therefore, a covenant breach would result in the loan being classified as current, since the lender has the right to demand immediate repayment. So, prior to these amendments, the guidance around all of this wasn't very clear, it was kind of murky. And so there was diversity in practice on a number of aspects relating to covenants, such as how should the loan be classified if the covenant is to be tested after the reporting period? Or should management's expectation of the covenant being complied with be considered for classification, and so on. So paragraph 72b now introduces explicit requirements for which we have summarized into a nice simple flow chart on the next slide. So what the requirement of 72b now lays out are as follows. So if compliance with the covenant is required to be on or before the end of the reporting period, in other words, the answer to question in the flow chart is yes, then the covenant does affect whether the right to defer settlement exists at the end of the reporting period. And this is the case even if compliance is only tested after the reporting period. On the flip side, however, if compliance is not required on or before the end of the reporting period, then the covenant doesn't affect whether the right to defer settlement for these 12 months exists at the end of the reporting period. So for example, if you have an off-period year-end like November 2024, but you have a loan with a covenant and covenant compliance is required to be tested annually on December 31st, then in this case, whether or not you breach the covenant at December 31st, 2024 has no impact on the classification of the loan in the November 2024 financial statements, because the test is only happening, because the compliance is only required after the year end, after the reporting period. So that's kind of the key takeaway here. Okay, so looking back to the standard now, paragraphs 74 and 75, these are the paragraphs that set out the requirements in the case of a breach of covenant. So there was no substantial change to these paragraphs in the amendments. However, they are relevant to our discussion as they are critical for determining the classification of loans with covenants. So I just wanted to quickly run through them. So paragraph 74 requires an entity to classify the liability as current when an entity breaches a covenant of a long-term loan arrangement on or before the end of the reporting period, with the effect that the liability becomes payable on demand. So even if the lender agreed not to demand payment as a result of the breach after the end of the reporting period and before the authorization of financial statements for issue, the liability would be classified as current. This is because the classification principle rests on whether the right to defer settlement for at least 12 months existed at the end of the reporting period. If the lender agreed not to demand repayment before the end of the reporting period, that's fine. If they agree after, that doesn't get taken into consideration. However, paragraph 75 requires an entity to classify the liability as non-current if the lender agrees by the end of the reporting period to provide a period of grace ending at least 12 months after the reporting period, within which the entity can rectify the breach and during which the lender cannot demand immediate repayment. Okay, so something we see often for a breach of covenant is that the lender provides a waiver or a period of grace. And so I wanted to take a couple minutes just to look at what these mean. So while IAS 1 doesn't define period of grace, the term waiver isn't used in IAS 1 at all. So there is definitely some interpretation here. So in our view, a waiver means that the lender surrenders its rights related to the breach of covenant and cannot reverse that decision. It's a contractual surrender of rights, essentially. A period of grace, however, generally refers to a time period given by the lender during which the lender agrees to temporarily not demand repayment due to the breach. So at the end of said time period, the lender will regain the right to demand immediate repayment as a result of the breach. So one is a temporary, one is a permanent kind of break. So therefore, So alternatively, a lender may give a period of grace by not demanding immediate repayment when there is a breach of a covenant, but they may reserve the right to demand immediate repayment at any point. So they might give you a break, but contractually they can still technically demand repayment. And this could be accompanied by a requirement for the borrower to submit regular financial information to the lender, such as monthly accounts, which enables the lender to monitor developments and decide whether it will minimize its losses by allowing the borrower to continue to trade or by foreclosing on the loan. And so what I'm getting to here is that in some cases, legal interpretation may be required to determine or decide the exact nature of relief to be provided by the lender. Okay, next let's take a look at a clarification that was made with the amendments regarding rollover rights. So the revised IAS 1 paragraph 73 now provides clear requirements for when an entity has the right to roll over an obligation. So if an entity has the right at the end of the reporting period to roll over an obligation for at least 12 months beyond the end of the reporting period under an existing loan facility, then it classifies the obligation as non-current, even if it would otherwise be due within a shorter period. It goes on to mention as well that the potential to negotiate a refinance is not relevant, emphasizing that the entity has to have a contractual right to defer that payment. All right, next slide, please, Andy. So in some cases, the right to rollover may be subject to the entity meeting a covenant requirement. And in these cases, there is obviously interaction then between paragraph 73 and 72B that needs to be considered. IS1 doesn't explicitly set out requirements for these cases where they interact with each other. However, in our view, IS1 paragraph 73 and paragraph 72B are complementary to each other. In other words, if the right to roll over is subject to a covenant test and the entity is required to comply with the covenant test only after the end of the reporting period, then that covenant will not affect whether the right to defer settlement exists only at the end of the reporting period. Thus, the liability is classified as non-current. And just remember that with covenants, we need to pay close attention to when the entity is required to comply with the covenant. Right, so the amendments also inserted paragraph 75A, and what this clarifies is that the classification of a liability is unaffected by the likelihood that the entity will exercise its right to defer settlement. So said differently, if a liability meets the criteria in paragraph 69 for classification as non-current, it's classified as non-current, even if the management intends or expects the entity to settle the liability within 12 months. So taking a step further, even if the entity actually does settle the liability between the end of the reporting period and before you issue the financial statements, that liability's classification will still be non-current, even if you know that the liability will be settled, because it all comes down to the contractual rights at the end of the reporting period. It's not about what actually happens or what you expect to happen. Of course, in either of these circumstances, there may be disclosure around the timing of settlement that goes in the footnotes to enable the users of the financial statements to understand the impact of the liability on the entity's liquidity and financial position. But obviously, we're just looking at purely classification on the balance sheet here. Okay, then the final thing that the amendments introduced was a new disclosure requirement, which thankfully is quite logical, to be honest. So the requirements only apply in situations where an entity has classified a liability as non-current and the entity's right to defer settlement of those liabilities is subject to them complying with covenants within 12 months after the reporting period. So in such situations, the entity is required to disclose information that enables users of the financial statement to understand the risk that the liabilities could become repayable within 12 months after the reporting period. And the disclosure is required to include information about the covenants and the carrying amount of the liabilities, and facts and circumstances that indicate that the entity may have difficulty complying with the covenants. Okay, so obviously that's a lot of content, a lot of referring to the standards. So thankfully, now we've seen the nuts and bolts. For practicality, we've summarized them all into a handy flowchart. So I would definitely encourage everyone to download these slides so you have access to this flowchart, because I think it does a really good job of simplifying what can be a really complicated analysis by breaking into a series of fairly straightforward questions. In the interest of time, I'm not going to step through every single question. I think they all kind of will be repeating what I've already just said, but definitely save this down as reference material. Sandy, if we could just skip ahead to, you might need to do a lot of clicking to get through the animations and slides. But yeah, as you do that, so there's a couple of takeaway points that I just wanted to emphasize for when using this flowchart. Firstly, the flowchart is for assessing the classification of loans as current or non-current. It doesn't cover any other types of liabilities, so provisions or anything like that. Secondly, the flowchart is applicable to annual as well as interim reporting periods. And thirdly, the flowchart considers the classification requirements of IS1 for loan arrangements only in the context of the settlement of the loans being in cash. In other words, it doesn't consider other modes of settlement, for example, conversion into equity instruments. That's a much more complex and less common analysis that needs to be done. Okay, I think I will leave it there, Andy. I've got, obviously, like I mentioned earlier, I have some more slides in here just around the amendments to the meaning of settlement. However, I don't think we need to cover that as it's not as prevalent, but I really wanted to make sure we got through these key points because, like I said, I think it'll be applicable to a lot of our listeners today. So with that, I'll hand back over to you, Andy, to take us through the poll and bring us home with the next section.
Great, thanks, Shane. Yeah, I think the materials are available if you need them, so definitely worth flicking through those. It's an interesting update to the standard there. Okay, so the polling question is, IS 1, paragraph 73 provides the requirements when an entity has the right to roll over an obligation. And so just a quick sense check there, is it A or B? Okay, all right. And so I think 90% of you are right there, that A was the right answer. So let's move on to the next slide. Okay, so now we're just going to talk through some IASB and IFRIC agenda updates, just to give you a flavour for what things that are happening with the IASB and potential changes that are coming down the pipeline. So this is quite a big one I wanted to spend a little bit of time on, and that's IAS 28 exposure draft that was released on the 19th September 2024. So IFRS accounting standards require entities to use the equity method in their consolidated financial statements to account for investments in associates and joint ventures, unless they're exempt to do so. Entities are permitted to use the equity method in separate financial statements too, for investments in subsidiaries, joint ventures and associates. Interesting sidebar on that, actually, I'd never seen the subsidiaries being used, applying the equity method previously, but we did see that in a recent example. So one to bear in mind if you do have those separate financial statements. So the exposure draft proposes a revision to IAS 28, which could significantly affect entities that apply the equity method. So entities with loss-making associates or joint ventures and entities with transactions with associates or joint ventures might be particularly affected due to the clarifications and measurement changes proposed by the exposure draft. So I'm going to run through like the main proposals, maybe, and give an example of one, just to give you a flavour of what's being proposed. So the first one is around initial measurement. So the proposal is that in IAS 28 paragraph 10 requires an investment in an associate or joint venture to be recognised at cost on initial recognition. However, IAS 28 does not currently specify how to measure the cost of an investment when obtaining significant influence. So the exposure draft introduces the definition of cost of the associate and joint venture and the fair value of any previously held interest. There's also a clarification on accounting for contingent consideration and deferred tax effects. Another one that could be relevant and interesting in practical application is changes in ownership interests while retaining that significant influence. So when you purchase an additional ownership interest, that should be measured at fair value of the consideration transferred. That's the current line of thinking in the exposure draft. And then in the case of a partial disposal, the partially disposed portion should be measured as a percentage of the carrying amount of the investment. So some practical assistance coming in through that one. Another area they're looking to update is around the investor's share of losses. So IAS 28 paragraph 38 currently requires an investor or joint venturer, an investor or joint venturer to discontinue recognising its share of losses if the carrying amount of its investment is reduced to nil. So IAS 28 paragraph 39 requires additional losses to be provided and a liability recognised only to the extent that an investor has incurred legal or constructive obligations or made payments on behalf of the associate or joint venture. If the associate or joint venture subsequently reports profit, the investor resumes recognising its share of profit only after its share of profits equal the share of losses not recognised. So that's the current guidance. The new proposals would require that there's no catch-up of unrecognised losses when you have the purchase of an additional ownership interest. It also provides a little more guidance around the application of losses if you've got losses that span across P&L and OCI, exceeding the net investment. It talks about applying, firstly, the share of the losses should go to the P&L with any residual going to OCI. So let me just give you a quick example there. So if entity A's carrying amount of its investment in entity B, which is an associate, is currency unit 5,000 as of 31st of December, before recognising its share for the entity B's profit or loss and OCI for the year end, December year end. So it's currently valued at 5,000 at the year end. Then when you look at the results of entity B and the share of entity A's share of those results, they have a $4,000 loss in the P&L and then a $3,000 loss in OCI. So you've got a total of 7,000 of losses, which is greater than the 5,000 carrying value. So you've got a question of how do you recognise those losses and how do you divide it between P&L and OCI? So the exposure draft is saying that you should, first of all, fully recognise anything that's going towards the P&L. So in this example, you'd recognise the whole 4,000, the share of the loss of 4,000 in the P&L. And then rather than taking the full 3,000 that would go through OCI, you just take the additional 1,000 to get you to reduce the carrying value to zero. So that's the good example of where if you've got a P&L and OCI impacts for investments in associates. And then probably the other one that we think might have a reasonable impact is how to handle transactions with investments in associates and joint ventures. So IAS 28 currently requires an investor or a joint venturer to recognise gains or losses resulting from transactions both upstream and downstream with an associate or joint venture only to the extent of the unrelated investor's interests in the associate or joint venture. So the exposure draft is going to require recognition in full of gains or losses resulting from upstream or downstream transactions with those associates or joint ventures. So that's some clear guidance on that topic, and one where I think potentially there's a diversity in practice previously. So note that the exposure draft was open for comment until January of 2025, and those comments are currently being analysed by the IASB. So we expect to hear more on them in the coming months. So conscious of time, so just a quick run through the latest IASB meeting. So in January, the IASB met in London, and they talked about pollutant pricing mechanisms, which I won't touch on too much. They also talked about business combinations and disclosures of goodwill and impairment. So at the moment, there's a project going on in this area, and the IASB discussed the feedback that they'd received on the exposure draft that they actually released on that topic. They also talked about the provisions and the targeted improvements that are being made, and they decided not to extend the exposure draft comment period, although there had been some requests from national standard setters for that to happen. They also touched upon the IFRS 19 and some updates that have been proposed on that topic, so stay tuned if that's going to be relevant for you in the coming periods. So then in a February meeting, the following topics were discussed. So I just want to touch on a couple of these briefly. So financial instruments with characteristics of equity. The IASB discussed feedback on the requirements for the presentation of equity instruments and disclosures proposed in their exposure draft. And the plan is for the IASB staff to discuss those potential changes with consultative groups and also seek their input on the timing and finalising of those amendments. And so, yeah, specifically thinking whether they should expedite any elements of them. and with bearing in mind the updates that are coming through IFRS 18 and the presentation and disclosure changes that those are going to bring. So they want to maybe try and align those changes. So at the moment, no decisions have been made on that topic, but it's one that's definitely being discussed a lot. They also talked about the intangible assets project and initial feedback that they'd received on the research and on their activities and research that they'd done. So they're going to provide, the staff's going to provide some further analysis on the topic and look to develop like a more structured timeline. This is quite an old standard that does need refreshing, especially around topics around things such as cryptocurrency. So again, it's one that's in the pipeline, and look out for more stuff. I'll just touch briefly on also the amortized cost measurement topic that they're discussing. So the staff suggested building up a project plan with the objective of addressing application matters arising from the amortized cost measurement requirements in IFRS 9. So there are widespread, and sometimes this is a widespread topic, and differences in practice can lead to some diversity in application. And so they're trying to essentially reduce any diversity by clarifying the amortized cost measurement requirements, and also clarify the interaction between IFRS 9 requirements on amortized cost measurement and impairment. So again, that's another one where I know this is an area where we've looked for more guidance on this, and so I look forward to seeing those updates. Okay, I'm going to just very conscious of time, so we're going to skip that. The IFRIC agenda, the IFRIC committee met in March. These are the topics that they touched on, but none of them are broad relevance, so I won't touch on those too much. I'm just going to open up the final poll, and then we'll get ready to hand over to Jeff in a moment. So we've got the next couple of slides talk about our resources and the materials that are available to help you if you've got IFRS issues. So I'll run through those shortly in a moment. But the polling question is IAS 28 investment in associates and joint ventures sets out how to apply the equity method. Obviously, I talked about that a little bit. So is it A, agree, or B, disagree? About 70% participation. Get that up to 80. Okay. All right. Excellent. Okay, so then I will switch to, I talked about the resources and the upcoming webinars. Again, feel free to look through those slides if you want to get more information about the resources that we have available as a firm. All right, I'm going to hand over to Jeff to wrap it up. Thanks, everyone.
Excellent. Thank you very much, Andy. That is the end of today's training. I want to once again thank our presenters for the informative discussion, and also Chartered Accountants Worldwide Network USA for providing the opportunity to present. Looking forward, our next webinar will be on Thursday, April 3 at noon Eastern, on the secret weapon of great internal auditors, that being sales and relationship skills. So that is the end of today's webinar, and you may now exit. Thanks again. Have a great day.